Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the weekly trading reports from October 23rd, 2011. We have a bearish normal market that's right at the midpoint on an annual weekly RSI basis. At 106 on the 10-day NDX, we had a breakout on Friday and are overbought. Percent stretch relative to the 200-day moving average is at minus 2.05% in the yellow, which is a fraction away from entering sideways market conditions. Slope of the 50-day moving average at 0.57% to the positive is bullish and rated green, meaning that's among the strongest readings of the past 6 months. ADX 14 has declined to 12.8, a weak sideways untrending market, with the good news for the bulls being that bullish trend action has increased and is at the top of the channel. ATR percentage has declined to just about normal for the past 6 months at 2.40%. The blended monthly rebalancing portfolios are holding defensive plays TLT and SHY until 1 November when rebalancing is in order. This week, ETF2 Weekly purchased TLT and XLU at the open. The theoretical exposure for the week ahead is at 20%. The model portfolio is at 20%, so no additional buying. This is a review of those 13 and 26 ETF portfolios and their current readings. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple line at 137 is the swing high that goes back into April. The horizontal solid red lines are resistance and support levels from the past 6 months. The dotted purple lines are resistance levels going forward we've seen for the last 6 months as well. So we got price that's right in between these two resistance lines at 122.5 and 125. Was able to close higher on Friday and break through that key support level at 122, so that's favorable. The solid black line in the middle is the 30-day regression line. It's sloping upwards. You can see that the slope indicator is above the zero line. The outer black lines are the channel that are formed by the maximum excursion from the regression line during the look-back period, which happened in the first couple days of October. So we have price that's above the 10-period moving average, above the 50, and closing in on the 200-day moving average in the top half of the regression channel. Williams percent R10 were overbought and have been for some time. Percent price oscillator flashed a bullish signal early in October and has remained, the jaws have remained open as price has moved up. So what we have is a market that has responded well to the sell-off in early October. Had one good week, one average week, and one sideways week, but which closed strong on Friday with a gap up and maintained. And so we'll be looking to see if there's more strength that'll get us into the sideways through key resistance around 130, and then with a chance to make a run at 137. With the ADX line below 12, and with this consolidation from the last week in place, acting as support, we could see a run to 137 in the next 2 to 4 weeks, and that would be well within normal boundaries. A failure below 120, however, would set up a retest of 112 and then possibly all the way down to 107. So we have a tactical market here that is just about ready to enter sideways, and the short-term trader who can measure risk and cash winning trades during the day with minimal overnight risk is still in very good position right now. Once the market votes by getting out of the sideways condition or starts to fail, then normal trend following will begin to be attractive again. Looking at the top 10 ETFs of the ETF2 database, 2 of the 10 are on buy signals, better than their 4-month moving average. That's the S&P 500 and the Tech 100, the NASDAQ 100. That leaves us at 20% invested and 80% cash for the week ahead. SPY, the U.S. at 38 is slightly better than the rest of the globals at 30. Within the U.S., the strength is technology, then large caps, mid caps, and finally small caps. U.S. tech and the U.S. large caps are the two strongest of the 10. The two weakest are emerging markets in Latin America, as has been the case for about the last 6 weeks. World market model showing strength, although it is declining somewhat in gold, silver, and treasuries. Strength in the defensive sectors of staples, utilities, and healthcare. Global technology still pretty strong, although not into the green quite yet. U.S. large caps above average, the mids and smalls below average. Europe and Asia equally weak, and emerging markets, Latin America, and the Western Hemisphere countries also very weak. Looking at intermediate term technicals in the 100 by 200, utilities and treasuries are still the strongest. Lots of short signals still, although with one more good week, we would see a lot of these short position, indications move into cash. Top 30 ETFs in the ETF2 database are dominated, as they have been for the last 3 months, by bond funds. We do have a few equities in there with XLU, utilities, XLP, this consumer staples, and RTH retail holders have found their way onto the list. But by and large, dominated here by short-term interest-generating ETFs and precious metals. Looking at the top 30 based on average daily dollar volume, we have a list here of highly liquid and sufficiently volatile ETFs that make good intraday and swing trade candidates. And they're ranked here by the daily average dollar volume of the last 30 days. We're going to shift now to the daily report. And what we have in the gap stat is in the last 30 days, 14 times, the market has gapped down. 5 of those 14, it has continued to fail for an average of minus 1.3% follow through. 9 times it has gapped down and then reversed to close higher with an average follow through of 1.37. 6 times the market has gapped up and then reversed to close lower for an average follow through of minus 1.48. 10 times the market's gapped up and continued to close higher with an average follow-through of 0.84%. The big returns right now are on the gap reversals. Gap down and reversal or gap up and reversal has been the higher payoff. You can see on the 10-day NDX, the market has been overbought for a period of time. In the overreaction system, the Dow 30 Industrials are flashing an overreaction sell. You can see how volatility has declined back to the median of the last 180 days. And the ADX line measuring strength of trend has declined, but now the bulls are starting to pick up the pace with Friday's good close. The 10-day max pain, we have Bank of America, IBM, General Electric, Hewlett-Packard, and Alcoa as the max pain candidates from the Dow, with the VIX, gold miners, treasuries, China, and silver in the ETFs. Only a couple pattern trades to note, a triple screen in the VIX and channeling system in TLT. We also have an IBM signal in the Dow for the 551W and a handful of dojis in Microsoft, Cisco, General Electric, and JP Morgan, but no other pattern trades to note. And you can see the 5 leading candidates for maximum pain range compression: IBM, Johnson & Johnson, Microsoft, HP, and AT&T. In the ETF 30s, only 2 dojis in Japan and in S&P Technology, channeling signal in treasuries, triple screen in the VIX, and then the usual suspects for the 5 candidates for max pain range compression: VIX, long-term treasuries, gold, silver, and agriculture. Among the highest fraud quality numbers, we see AT&T with a fraud quality index number of 4. Verizon, Pfizer, Walmart, and then Latin America and Brazil. From the ETFs, Caterpillar and Procter & Gamble rounding out those with exceptionally strong frog quality numbers. In the signal-to-noise ratio, it's worth noting Travelers, U.S. Tech, J.P. Morgan, S&P Tech, Consumer Discretionary Materials, as all being exceptionally strong intraday trending with signal-to-noise ratios greater than 0.5. The fail stat, just for your reference, and in IWM as an example, in the last 30 days, it has fallen on average $1 from the open to what became the low of the day. So a handy indicator for estimating if the low of the day may have actually been set in the opening hour. Looking at the market mosaic, strength on Friday tilts the regression line up just a little bit more. R squared is improving up to almost 0.15. As on the time series, you can see the regression line slope now almost 1 standard deviation above the 6-month average and above the dotted line, meaning that the slope is positive. You can see when we zoom in that the crossover occurred about 8 trading days ago, when the market would normally ought to have failed here. At the doji, it continued to press higher, and that's cautiously bullish. Percent stretch has moved a full standard deviation off the last low and is now approaching the 0 line when it gets into sideways conditions. So that's also a longer-term, tentatively bullish sign. Intraday range percentages for reference and holding periods for reference. In the Dow 30 quality report, we're looking for divergences between this past month's system quality number and 2 months ago, with candidates for improvement being Intel, Disney, Hewlett-Packard, and ExxonMobil. Among the ETFs, S&P Technology looking the strongest in terms of relative improvement. You can see just how much gold and silver and DBA have fallen. They were all exceptionally strong 2 months ago, and now are all exceptionally weak. That's part of the move back into equities with venture capital as the risk-on trade has become a little bit more attractive. Gap statistics and the safe zone, you can see, has been adapting upwards as the market has continued to slowly improve. Pivot points on various time frames for all the big indexes. In the alpha stat, technology has gotten a little bit weaker on weakness in Apple, while mids and smalls have now moved out ahead of the S&P large caps. That's an indication of risk on trade becoming more interesting. Gold, silver, and commodities have actually done a little bit better this last week as they've hooked up. The S&P turned sideways, but the precious metals and commodities gained a little bit. The globals have not healed as much as the U.S. sector, so strength can still be found in the U.S. rather than among the globals. So that's a quick look at the weekly trading plan and the daily trading plan for next week. This is Ken Long from Tortoise Capital Management. Keep your risk measured and your powder dry.